Hello and welcome to Earnings Echo. We put together the most important information about Workday.
Great to be here. We have a lot of data to get through in this deep dive.
We really do. Let's just get right into the numbers for fiscal year 2026. On the surface, this actually looks like a solid quarter.
It does, but the market punished the stock today with an immediate 8% drop.
Right, an 8% haircut right out of the gate. What is the disconnect here?
It is basically a classic beat and raise failure. I mean, if you look strictly at Q4, they executed perfectly. Total revenue hit $2.532 billion.
Which is up 14.5% year over year.
Exactly. And subscription revenue, which is the number you really need to care about here, grew nearly 16% to $2.36 billion.
And on the bottom line, they delivered adjusted earnings per share of $2.47.
Completely clearing the $2.32 analyst expectation.
So we have a very clean beat on the top and bottom lines. The sell-off has to be entirely about the forward guidance.
It is. The outlook for fiscal year 2027 was just a cold shower for investors. The market had this psychological target of $10 billion in subscription revenue for next year.
And Workday guided just under that range.
Yeah, implying growth slows to about 12 to 13%. But even worse, they guided to a 30% operating margin.
Which is essentially flat year over year. That's the real sticking point, isn't it?
It absolutely is.
Because for a software company at this scale, flat margins imply zero operating leverage. You expect efficiency gains, not stagnation. Why aren't we seeing that profitability flow through?
Because management is actively choosing to suppress it. CEO Anil Boozary is back in the driver's seat, and he is prioritizing a massive pivot over short-term margins.
Right, the AI investments.
Yes, they are accelerating spend specifically on their agentic AI roadmap. They're effectively telling the market, look, we are going to spend heavily now to secure our relevance later.
Let's clarify agentic AI for a second. We hear AI thrown around constantly in these reports. What is the material difference here for an HR and finance platform?
It's the difference between a chatbot summarizing an email and an agent actually doing the work for you. These agents perform tasks like scheduling, database updates, anomaly detection.
All without human intervention.
Precisely. And they have 12 of these agents in general availability right now. They're also seeing strong performance from acquired AI assets like HiredScore, Paradox, and Sana. But this technology shift creates a massive friction point for their core business model.
You're referring to the pricing structure.
Yeah. Workday has historically made money by selling seats licenses per employee.
But the whole value proposition of AI is that companies become more efficient and potentially hire fewer people.
That is the existential tension right there. If their AI succeeds, their clients' headcount growth slows down. And if headcount slows, seat-based revenue stalls.
Which explains why the flex credits discussion on this call was so critical.
Exactly. They are trying to shift large clients to consumption-based pricing. You stop paying for heads, and you start paying for the actual work the software performs.
It's a defensive hedge against sauce fatigue.
It is, but it also makes revenue much harder to model in the near term.
Speaking of modeling difficulties, I noticed a sequential issue regarding a DIA contract. What is the story there?
That is an optics problem for Q1. In the fourth quarter, they recognized revenue from a massive deal in the federal space that boosted the numbers significantly.
And that deal does not repeat in Q1.
No. So even though the core business has elite gross revenue retention at 97%, the sequential growth looks like it drops by roughly $25 million, just because of that tough comparison.
So basically, we have a stable core masked by a tough comp, combined with a risky business model transition. What was the sentiment on the call regarding the timeline for this AI payoff?
Management described themselves as unabashed optimists for the long term, but the financial reality is heavily backweighted. They admitted the monetization from these AI agents won't really show up until the second half of the year.
Which leaves investors holding the bag for a transition year.
Correct. The big echo you need to take away today is that Workday is attempting to rebrand from an ERP to an enterprise AI platform.
And investors have to watch if this flex credit consumption model successfully offsets the natural deceleration in seat-based growth.
Right. The bet is that organic AI agents will re-accelerate growth in fiscal 28. But for fiscal 27, margins remain suppressed while they build the scaffold.
A clear case of short-term pain for long-term gain, and the market clearly isn't in the mood to wait. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.